We have a quick question here from Gavin saying that whenever we have a sideways bias or a neutral bias for a particular currency or particular currency pair or instrument, can we consider that as an opportunity from a technical point of view to trade it as a bounce, or trade it as a bounce to the upside from the bottom end of the range and trade it as a sell trade from the top end of the range? Now, Gavin, from a purely technical point of view, I mean that is something that you can consider doing. I mean, something like the S&P 500 has been a good example of a range-bound mover this week. We did expect it to either pull back further or remain more range-bound in the run-up to the FOMC meeting that we have coming up today. So, given the fact that we are expecting it range-bound, you could, for that reason, trade it. From the tops, selling it down and then buying it at the lows. The challenge of trading anything that's neutral or range bound is that the the normal reason why we're not trading it as a trending move is because there's either no catalyst for it right there. So there's either no immediate catalyst or sentiment that should be driving it up or down. And the other option is that apart from not having a catalyst, we might have two strong currencies versus each other, for example, right? So let's go over to the currency space. Let's open up. Let's take anyone. Let's just take the Aussie versus the US dollar. So in this week's session, from basically the 8th of June, we did expect either a pullback or a range-bound market on this. In the run-up to that Fed event, obviously the market's looking to de-risk before it, not looking to take new positions until we get that FOMC event, which will be the main event for this week in terms of scheduled data points. So could you consider trading something like the Aussie US dollar in this type of range, basically selling it at the highs, buying at the lows? From a purely technical point of view, you can do it. We are expecting it to remain more neutral and range bound, but it really comes down to what are you risking for the potential gain that you're getting. So whenever we want to be trading, whenever we want to enter something, you would obviously want a very clear reason for why you're entering a trade. You would want to enter that trade with a clear catalyst, a clear plan in mind for why the market would want to be buying or selling it. If you compare that to a range-bound market or a range-bound move, there's really no incentive for the market to be a buyer or selling that pair. So yes, you can consider buying high and selling low, as long as you realize that it's going to be a very low conviction opportunity. So it's going to be low conviction, low probability, because imagine this happening, right? So imagine it comes down to the bottom end of the range and you decide to take a stab at it down here. And let's say you want to keep a tight leash on it and you have a stop somewhere down here. And what happens is the market makes a run like yesterday. No catalyst, just probably profit taking, and it slams right into that level. So you take your entry and the market starts moving up and you're like, okay, it's a range bound move, it's okay. And suddenly right at this low, you get a catalyst, something, Donald Trump coming out and saying that he's going to have some sort of retaliatory action against China. Boom, it suddenly breaks through that support zone. And now you're very, very close to your stop, and suddenly it gets taken out. Okay, so you lose the trade. Only to see the markets basically, negate the statement, because it is a range-bound market. They're waiting for FOMC. Now suddenly you get a candle that looks like that. So you break through the level. Your stop gets taken out, and now it moves up. So now, like, okay, surely now, the range is going to hold. So you enter another position, you place your stop down here, and you're like, okay, it's surely going to go up now. And now suddenly, even though the market has a range-bound bias, it just starts to meander around this level. It's not really doing anything. It's going a little bit up, a little bit down. So you're in and out of profit the whole time, and suddenly you're an hour away from FOMC. What do? Do you close that position? Do you remove your stop? There's so many things that can go wrong with that FOMC decision that can just cause you to take another loss on the trade. So the point I'm trying to make with this illustration is just that you can surely trade it, from the tops to the downside and from the bottom to the up if we have a range bound expectation. But as long as you know that it's going to be very low quality, low probability, low conviction trades that won't have a very very high success rate. Then of course, if you keep your risk very low, you can try and trade it. But I would prefer trading something where the market has a particular reason for wanting to trade it, either up or down. Remember, it's much easier to trade a trending move than it is a sideways move, right? And you can get really chopped up in the short term from range bound markets. So trading something that is expected to be trending is obviously going to be a lot easier from a technical point of view, at least, getting in at good spots and getting out at good ones as well. So just keep that in mind. It's obviously every trader's prerogative on whether they want to trade something like a range bound market, just as long as you understand what the risks are of trading in that type of environment.